Well, good afternoon, ladies and gentlemen, and a very warm welcome to the latest in our series of Scottish Business Resilience Centre webinars. Today's webinar will focus on the challenges to credit unions in Scotland during the current COVID-19 crisis and perhaps look a wee bit beyond that. My name is Graham Clark. I'm an associate at the Centre, and I'm absolutely delighted to say that we have an excellent panel of speakers today for today's event who will impart their views and their knowledge on some of the challenges that are facing credit unions just now. And that's about some of the recent guidance that's been issued. And it's also about some of the financial assistance and some of the challenges to business practices to overcome. As you may well have noticed, if you're settled at your screen, everybody's microphone who has dialed in has been muted by us. Now, that's not in any way to silence your views at all. It's just to reduce the background noise when the speakers are actually speaking and make sure that they don't get drowned out. And in fact, we would actually welcome any questions that you have during any of the inputs or during the webinar in general. And what I would ask that you do, if you have any questions at all, could you submit them through pressing the Q&A button on the bar, which will be at the top or the bottom of your screen, and avoid using the chat button if that's possible, because moving between the chat button and the Q&A sometimes is a bit unwieldy for us. So if you have any comments or any questions, if you could put them in through the Q&A, that would be much appreciated. Please be aware that any questions that you do ask through the Q&A will be available to anybody who's in the webinar, and they will be able to see the question or the comment that you put up and also the answer that we will give. But feel free to use that to ask any questions that you have. So you have probably heard far too much from me. So can I now hand over to the first of our speakers, Stephen Cunningham. Stephen is a partner at Alexander Sloan, and he's going to discuss the recent COVID-19 guidance from the PRA. Thanks, Stephen.
Thank you. Okay, good afternoon. The first thing I'd like to cover is just the new capital requirement rules that came out in March. We're still seeing a number of questions on this topic. So just with a recap, for large credit unions, capital requirements are now based on asset size. So instead of the previous 8% plus 2% capital buffer, we now have a tiered ratio. So under the new tiered ratio, a large credit union must have in capital an amount equivalent to 5% of assets for the first 10 million of assets. And on top of that, an amount of 8% of any assets between 10 and 50 million in capital. And then in it, plus any amount over 50 million, they must have 10% of that in capital as well. Now, you still need to be careful of sections 8.8 and 8.9 in the PRA Credit Union Rulebook. 8.8 means that there's a requirement to transfer 20% of your surplus to reserves where your ratio is under 10%, and that still remains in place. It can be a lower amount if this is what you need to bring your capital ratio up to 10%. With 8.9, you can't also transfer from your general reserve if your ratio is below 10%, and you need to keep that in mind when you're looking at paying dividends. The main thing I wanted to cover, though, was the letter to credit unions on the 8th of April. There was a number of key points in this letter. They stressed the importance of sound governance, risk management, and general prudence. And they've said that credit unions should look at how they continue to hold board meetings and produce management information in the current climate so that they can continue to manage the key risks. They've also emphasised the need to contact the regulator if you've got any issues with your capital, liquidity, or if there's anything else that they need to be aware of. The main thing, though, in the letter was the waiver available with regards to the bad debt provision. It's available to all credit unions up to the 1st of January 2021. And in order to obtain the waiver, all you need to do is send a short email to the PRA confirming that you wish it, along with your credit union's name and reference number. You should then get a confirmation from the PRA, and your name will appear on a list of credit unions on the PRA website. So if you take the waiver, what it does is it reduces the minimum bad debt provision. So for arrears between 3 and 6 months, instead of having to provide 35% of net liabilities, you would have to provide 20%. For loans in arrears 6 to 9 months, it drops from 60 to 40%. For those 9 to 12 months, it drops 80 to 60%, and it remains at 100% for arrears over 12 months. So it could obviously have a big impact on your capital. There is a note of caution, though, in the PRA's letter. They've stated that your board needs to consider whether or not this is appropriate. You've still got an overarching requirement to have an adequate provision, and that's both in the PRA rules and the accounting rules. So you need to consider if the new rules would lead to still having an adequate provision. And you need to take into account your membership base, historic and current rates of default. I would also advise, if you are looking to take it, you have a chat with your auditor as well. It's also important to note that it's available only up to the 1st of January 2021. So what I would recommend is that if you are taking the waiver, you calculate the difference between the new minimum requirements and your previous way of calculating it, and you report that to the board each month, along with detail of how it would impact your capital, just so the board's aware of this and they don't get any nasty surprises. And also, any projections you should be doing should take into account the bad debt provision will be increasing back in January. The letter from the regulator also states they'd be willing to accept delays in regulatory reporting. So for reports due on or before 31st May 2020, then they'll accept a 2-month delay on annual return and a 1-month delay on the quarterly return. They have stated you should only use this where you're experiencing particular challenges, and therefore if you don't have any particular issues, I would advise against using this. It just might flag something up to the regulator about the issues you're having. Just quickly, the FCA have special pages on COVID-19 with a lot of very useful information on that. They've certainly got special measures for certain types of loans, such as consumer credit loans, mortgages, car loans. If you've got any of these products, definitely worth looking at that. There's also specific money laundering guidance as well during COVID-19 on how to get that identification. They've also got guidance on complaints handling. They see that there have been 3 main priorities for handling complaints. Firstly, paying promptly complaints who have been offered redress and accepted that offer. Secondly, the prompt and fair resolution of complaints from consumers who are likely to be vulnerable to harm if it's not resolved promptly. And also micro enterprises, small businesses who are likely to face serious financial difficulties if their complaint is not resolved promptly and fairly. And lastly, sending timely holding responses to those complainants ensure that their complaints can't be resolved promptly. They've said if you can't deal with these 3 priorities from home working, then you should be looking at having a minimum physical presence in the office, while still complying with social distancing and government guidelines. Just want to finish by just a couple of points to watch. I know the regulators are looking for a lot of information from credit unions just now, and I would expect high level of regulatory monitoring to continue. It's certainly worth updating projections, scenario analysis. I mean, while it can be very difficult to predict what's going to happen with COVID-19, at least going through the process can help identify issues in the future. And lastly, operational resilience was a key topic with the regulator before this happened. I would expect when everything starts going back to normal, it'll be even higher priority from them. So expect to see a lot more from them on that topic. Okay, thank you very much.
Thank you very much, Stephen. That was hugely informative. And again, folks, if you have any questions for Stephen about that, the information that he shared, please by all means feel free to hit the Q&A button and to ask it, and we'll do our best to respond to it. Okay, our next speaker is Alistair Davis. Alistair is the Chief Executive at Social Investment Scotland, and he's going to provide an update on the government's credit union investment fund. So over to you, Alistair. Thank you.
Okay, hopefully everybody can see my slides. It's good to be with you today, albeit from the comfort of my own home, although you have given me probably one of my only excuses so far during the lockdown to actually put a shirt on, so I'm grateful for that. I don't normally look this presentable. So really what I wanted to do today, I realised that there's obviously quite a bit of interest in the Scottish Government's new credit union funding, as there has been since it's been announced, but I recognise that not many of you will be familiar with Social Investment Scotland and what it is that we do. And over the next 3 years, whilst the fund is being managed and deployed, it will probably become an organisation that hopefully you'll become a bit more familiar with. So in the time that we've got today, I wanted to cover very briefly some of the main things that Social Investment Scotland does, just about our history and the different things that we offer, mainly focusing on the credit union funding, particularly when it is in this phase at the moment when it's supporting the resilience of credit unions. So very briefly, Social Investment Scotland, it might be a new name to you in a credit union context, but it is actually a very established organisation. We will be 20 years old next year, and over that time we've invested now over £80 million in 400 organisations, largely across Scotland. We are an intermediary. We raise investment from a whole range of different sources, including corporates, individuals, governments and banks, also trusts and foundations like Carnegie, who you'll be hearing from shortly. And our mission with that money is to connect that capital with communities to make a real, measurable and sustainable impact upon people's lives. So we are a social investor. And what that means is we invest for both financial and social return. Financial return being classified as being at the very least the repayment of the amount of money that we invest. We fulfil this mission in a range of different ways, by raising awareness of social investment to those who have perhaps not used it before, providing loan finance, providing business support to support organisations to grow and scale, and also more recently providing investment into mission-led businesses. And if you have a look at the SIS website, you'll see a copy of our social impact report from last year, which tells you a bit more about the different work that we do. Just very briefly then, in terms of the different types of finance that we generally offer, credit unions have always been eligible to apply for funding from Social Investment Scotland, and indeed some have over those 20 years. But largely we fund a wide variety of organisations that make up the third sector, essentially any organisation that isn't classified as being a private limited company. And in terms of who uses that investment, the organisations that we support create an impact in a whole variety of different ways. You'll see the variety and breadth of things that we already support. What I would say is that more recently we've developed a particular expertise in supporting the affordable credit sector. And from the variety of different funds that we manage, we have investments in largely in the CDFI sector, community development finance institutions right across the UK. And 2 years ago now, we were appointed on behalf of the Scottish Government and the Carnegie UK Trust to manage the Affordable Credit Fund. So with the Affordable Credit Fund and the Credit Union Fund, then we hope that SIS will turn into a real centre of expertise for supporting people to get access to finance where the market is unable to provide them with services. Alongside the provision of finance, we also have a focus on market building and providing support to organisations to scale their activity and impact. So if any of you are not familiar with social investment and have not raised investment like this before, then a key part of our charitable purpose is about helping you understand what different concepts mean and supporting you through the process of actually raising that investment. But we also carry out a whole range of different activities to raise awareness of the third sector, the social enterprise sector, and now the credit union sector within the mainstream. That can be either on a regional focus, and in the past we've worked very closely with Highlands and Islands Enterprise, and also now working with a new enterprise agency in the south of Scotland, but also in particular on a sectoral focus. And we're particularly interested in supporting organisations gain access to mainstream markets. And I hope that by learning from the needs and aspirations and challenges of the credit union sector, that we might be able to develop, in partnership with you and other bodies, specific market building opportunities and support programmes for this particular sector. So in terms of this new fund, I know that it's something that's been spoken about for some time, ever since it was launched by the Cabinet Secretary. As many of you are aware, it will provide £10 million of funding over a 3-year programme. This is now the first year, so the year to March 2021 will be year 1, when there is £2 million of capital available. And in year 2 and year 3, there will be a further £8 million available, split £4 million across each of those 2 years. I'm also aware that there's been work that's been going on for some time with various different credit unions and representative bodies to shape the strategy for this fund. I think it's fair to say that as a result of COVID-19 and the crisis that's then ensued, some of that work is still outstanding, and the fund has perhaps been launched before all of that work has been completed. But I am aware that government officials are interested to come back to that to shape the strategy for the fund in future years. Although the focus of the fund at the moment is around about resilience and liquidity, there is an appetite in the future to look at other things that might support the growth and sustainability of credit unions, including innovation and new technology. The first phase of the investment fund has been badged as a resilience fund. That's £2 million. We have been appointed as the manager of that programme, and very quickly after having been done so, we launched an expression of interest process. And we're currently working with 20 different applications to that fund through a due diligence process. And we expect that probably by the end of June at the latest, all of that fund will have been allocated to a cohort of initial applicants. It was quite significantly oversubscribed, so we have been scaling back some asks where organisations perhaps don't need as much as what they had asked for. And we are engaged with Scottish Government officials about how there might be some additional resource applied, but I'm not here to make any promises around about that. We are in continual contact with officials around about how we take this forward. It is a repayable fund, but as part of the resilience effort, this phase of the fund is being offered at 0% interest, which is in common with other resilience funds being offered across the rest of the third sector, and is well, pretty unusual in terms of a social investor like CIS. It's being offered as a product called subordinated debt. Now this has not been used particularly often within the credit union sector, and some of you will be unfamiliar with how that works. There is actually a guidance note that's available on the CIS website that tells you more. It is a repayable instrument that has to comply with the PRA rules. Essentially that sets down certain criteria in terms of how long the loan must be for in order that it would count towards regulatory capital. So it has to be at least a term of 5 years. Most importantly is the second bottom point on that slide in terms of how the loan must be written down by 20% per annum from your capital calculations. That doesn't mean that we're looking for the loan to be repaid by 20% per annum when that exercise is going on. But obviously you must be making provision for the loan to be repaid at some point over the term of the loan, which is up to 8 years. And that's really the key focus of the due diligence that we've been carrying out so far. Just finally, this is my colleague, Brian McNee. He's one of our investment managers, and he will be taking on the portfolio of credit unions. What that means is you've got named, personalised contact from within the SIS team, providing ongoing support throughout your investment journey with us, somebody you can pick up the phone to and have a chat with. And as part of the conditions of the investment, there will be certain things that we expect you to provide to allow us to monitor performance of the investment. But largely that relates to receiving a copy of your normal returns to the PRA. We're trying to make it as easy as possible. But that also will provide access to the range of other finance and support that is offered by SIS. That's really all from me. I am happy to take questions in the question and answer box as required, or please feel free to get in touch with me directly at any point, and I'm happy to answer any questions that any organization might have. Thank you.
Thank you very much indeed, Alistair. I'm sure that will be of great interest to many of the credit unions out there, and I'm pretty sure that your colleague Brian's phone will be ringing off the hook very, very shortly following your input. But thank you very much. And again, folks, any questions, please feel free through the Q&A button. That would be great. Our next speaker is Neil Alexander. Neil, I'm sure, will be well known to many of you. He's an Affordable Credit Associate at Carnegie UK Trust, and he's going to discuss that how COVID is impacting on some of the decisions around lending and the challenges around about that. So I'll hand over to Neil. Thank you.
Hello everybody, hope you're well. Thanks to Graham, thanks to the team at Scottish Business Resilience Centre for the invitation. As Graham said, I'm an associate at the Carnegie UK Trust, and there I help them develop and implement the recommendations in their Gateway to Affordable Credit report. We work with a number of credit unions in our work there. And for the past year, Carnegie has also seconded me to work part-time with the team at Fair for All Finance. They are the organisation with access to the dormant bank account money in England, currently £55 million. And with them, I've been looking at their grant resilience fund for both credit unions and CDFIs. And it's with that background reviewing those applications, and they too have been oversubscribed. We've been looking at over 40 applications there, and so far issued around 2.5 million. So it's with that background and Carnegie's own soundings that are informing this presentation. I should probably also note that I am a director at Right Way Credit Union as well. So to begin, Warren Buffett, the so-called sage of Omaha, said in his letter to shareholders about the last financial crisis that you only find out who's been swimming naked when the tide goes out. What the tide has revealed this time around with this crisis that we are living through is clearly a gig and informal economy, with people in very precarious positions financially, lacking financial resilience through their savings, and very quickly needing to be supported in a number of ways. It has most certainly started as a health crisis. It's quickly becoming the greatest economic crisis that we have collectively faced. The Chancellor saying this is no time for political orthodoxy as he announced the most astonishing stimulus package that we've seen. We thought 2008 was bad with 1 in 50 mortgages in 3-month arrears and 46,000 repossessions in 2009, and at that time 8% unemployment, at least so we could go to the pub. So this time around, what we're looking at, we are unprecedented, seems to be the word that everybody is using. We have 1 in 9 households with a mortgage that have sought a payment break, payment holidays for unsecured loans, an astonishing number of universal credit claims. HMRC said that 6.3 million employees were furloughed, costing the Treasury an estimated £39 billion to the period to the end of June this year. That's about 27% of the workforce. I saw yesterday that Sky were reporting that number is 7.5 million The Resolution Foundation say that 9 in 10 people who are working from home are in the top half of income earners, with only 1 in 10 people working from home being in the bottom half of income earners. This is sadly, unsurprisingly, affecting poorest households the most. If any of you follow on Twitter the social commentator Darren McGarvey, known as Loki, you'll have seen that he said there are 2 types of people in this crisis, those with gardens and those without. Confidence is definitely gone on both sides. There's very little to consume. A report last week by the Centre for Economic Policy Research, looking at over 8 million transactions from 35,000 households, said, I'm going to quote this, since the second week of March, total expenditure has dropped by 40 to 50%, and the share of users experiencing an income decline during the COVID crisis has been significantly higher than before the crisis, with the median decline in overall income being around negative 30%. They also say, as do many others, the IFS and others, that the poorest will suffer the most. To all of that, we add the slump in car sales, the non-holidays that we'll all take this summer, unless we bizarrely go to France. There's nothing significant to buy. There is only so much paint and food that we can collectively consume. So lenders brace themselves for this, so too does the government, with an expected drop in GDP in the quarter that we're currently in of 25%. Credit unions being able to apply, as Alistair was saying, to a variety of funds for immediate assistance, but there's clearly a danger that, like the rest of the economy, the liquidity crisis might turn into a solvency crisis. From the last time, what do we know? Well, we absolutely know that those who can will save. The graph here, the orange line shows household savings over the last 40 years, and the blue line is the UK GDP. So you can see the blips that are rises in an otherwise downward trajectory of household savings. And you can see that those kind of counter those periods of GDP negative growth from the financial crisis the last time round, and from the recessions of the 80s and 90s. And of course, we expect that those who can will be cautious and save more. We've also seen 2.5 million individuals claiming universal credit between the 1st of March and the 28th of April this year. These are just off the scale kind of numbers. The ONS carry out, I'm sure many of you have seen this, but the ONS carry out a regular survey, weekly surveys of people, and they are seeing, again, this kind of points to the poorest suffering the most. The 2 areas that have had the biggest jump, albeit from low bases, are those who have said that they are using food banks and those who have said they've had to borrow money. So again, all of this kind of piling on top of each other doesn't look good. Whoever had 7 minutes into the presentation for the use of the term the new normal has won the sweep. The new normal and unprecedented being on everyone's bingo card. So there are various projections on the impact that there will be on sustainability. There is a huge range of predictions about what will happen, with a few exceptions, and I've spoken to lenders who are doing more lending. Most of the soundings that we've taken, and indeed the Fair for All grant process, are telling us that loan books are contracting and quality is reducing. There is a real challenge here. Of course, as you know better than I know, operational costs are largely fixed. Rent relief even is no good to you if you own your building, but the existing loan book will underperform. By what margin, we don't know yet. We'll only begin to scope that out, I think, from July, when the PRA get the next quarterly returns for comparison. The pipeline has reduced again. We are getting anecdotal evidence about what that is, but it looks like quality is also reducing. And even there, how do lenders make judgments around affordability and creditworthiness? I mean, how do you, in the current circumstances, with furloughed staff, with people worried about their futures, with the issues of redundancy, how do you make assessments on risk? And indeed, what would you borrow for? You know, cars, holidays, weddings. What are people consuming? There's a head and a heart issue here, I think, as well. there are people who are lending money, small sums of money for food and for bills, and you've got to question whether that's the right thing to do. Small loans for food, even with a relatively modest premium that credit unions apply, doesn't kind of really seem like the right thing to be doing in the circumstances. It all adds to an individual burden. There is clearly the spectre of some more unscrupulous insolvency practitioner activity around protected trust deeds. I know a number, including APCO, will be very concerned about that, and we absolutely need to be alert in pressing the policymakers and the AIB about these practices. There are other challenges too. Pandemic was apparently the #1 issue on the UK government's risk register, but it probably wasn't on many credit unions' ones. So how do you keep a form of business as usual going in this case? Moving from largely, in many cases, relationship to transactional lending, branch to telephone to online, with, and it has to be said, in many cases, a creaking IT architecture. There is investment required in a number of areas. I'm sounding as if I'm like a very cheerful, maybe not so cheerful pessimist on this. The pressure, of course, isn't unique to credit unions. This is all lenders are feeling the heat. The high-cost credit sector in particular, Bright House sank into administration, although that was, as many people saw, on the cards. Home credit clearly cannot collect on the doorstep. Online credit, online short-term credit are very concerned about just soaking up more future financial ombudsman claims. The grants and loans that are being offered and the stuff that Alistair was talking about, they are much needed right now and very welcome. And credit unions are, of course, in a space that governments of all hues, north and south of the border, all political parties support the work that credit unions are doing as they address issues of both public and social policy. I think if you're looking for positives, I think on the positive side, there is likely, I would imagine, to be a realisation of the interconnectedness of the world as a result of the COVID crisis. Ethical issues will clearly become more prominent, and credit unions are clearly well placed there. Employers, you would imagine, will become more interested in their employees' well-being as a result of the crisis. And as far as we know, there's been no run on shares from credit unions in this crisis. Indeed, I know of many, and some of you here on the participating today, I know of many who are seeing increases in deposits, sometimes flowing your way at the expense of banks. It's entirely possible that this process that we're going through will accelerate merger and acquisition activity. It's possible that it will speed up the need for common services like common back office, IT, aggregated media buy, that kind of thing, shift to digital, even collection processes. A number of these issues could mean fewer, stronger, potentially better lenders. This will end, I don't just mean the presentation, this will end at some point. We will manage a new form of normal. Don't forget, governments will need people to spend money. That is one of the few ways out of this. We need people to consume things. There will be incentives to get the housing market going with all of the associated spin-offs around new home purchases. There will be incentives to get the car sale market going. And who knows, a decent Scottish summer might bring out the need for garden furniture and the decking and the midge-busting machines and staycations. Organisations like Carnegie are currently surveying credit unions about their circumstances. I know it's already been mentioned by Stuart that many of you have been asked for more information at this time, and I'm afraid I'm going to ask you for some more here. So Carnegie, using their convening power, working with the University of Salford and supported by a number of trade bodies, including APCO and the Scottish League, are undertaking an anonymised short online survey to kind of identify what the evidence base is, to kind of put those anecdotes into evidence so that we can use that to help lobby stakeholders, and we would greatly appreciate your involvement in that. So if you are able to spend 15 or 20 minutes on an online survey for us, I'd be delighted if you would do so. Please contact me and I will send you the survey link and we will present those results. The survey is open now, it closes next Thursday, and we'll present those results shortly thereafter in our own webinar. So thank you again for the ask to speak. There will be lending, it will return, and there will be strong sustainable credit unions there to support their members when it happens. Thank you very much.
Thank you very much indeed, Neil. That was hugely informative, and yeah, no doubt that overused phrase, the new normal, will bring many challenges, but I think that very positive note at the end about there will be strong and sustainable credit unions with opportunities to contribute to the recovery is absolutely valid, and that's a very positive message to take forward, absolutely. Again, folks, if you have any questions for Neil, please, Q&A button on your screen, please feel free to hit it and ask any questions as we go along. Our final speaker for the day is Declan Doyle. Declan's a senior ethical hacker at the Scottish Business Resilience Centre, and I suppose really, as in all things, serious and organised cybercrime identifies opportunities, and unfortunately COVID has presented them with a number of opportunities, and you've probably seen some of the press coverage, but Declan will provide you with a wee update and dig a wee bit deeper into these headlines and perhaps tell you some of the things that you need to be aware of. So I'll hand over to Declan. Thank you.
Thanks, Graham. Right, so yes, Graham asked me to come on today to talk about some of the things that I've been seeing in terms of the COVID cyber risk. I've been working quite closely with Police Scotland and the Scottish Government, as well as partnering with the NCSC, and unfortunately we have seen, as predicted, that hackers will take advantage of any situation possible, and COVID has presented them with a massive opportunity to make the most out of people's panic and the change in circumstances and uncertainty that brings. So what we've seen is huge numbers of scams, phishing attempts, and so forth. So I'll run you through just some of the things that I've been seeing over the past few weeks, and then finish off with some things to look out for and some tips and tricks to help you out. So first of all, we've seen a lot of phishing emails coming from the government, or pretending to come from the government. Obviously, this, and again, the word unprecedented is thrown around, this unprecedented measures that the government have taken to offer financial aid. It's a hacker's dream, basically, to claim money from the government. So they have sent out emails that look like something like this, claiming to be from HMRC, asking you to click on a certain link to claim your COVID financial aid, whether that be an emergency tax rebate or a business loan, etc. These are always fake. The government will never issue an email like this and ask you to click on a link. And if you're ever unsure, please just reply, or please just get in contact with HMRC, and you can forward the emails on to the NCSC, which I'll touch on a bit later. We've also seen an increase in domain names with the name COVID in them, or something similar to COVID, and these are often linked to scam websites such as these. We've seen fake testing kits in almost lottery type situations, where they're asking you to put in personal information, sometimes even credit card information, and asking you for all this information so that you can potentially win a coronavirus testing kit. The government has said that the official channels for testing will be done through Boots in the high street and Amazon for national distribution. So any sort of website or email or communication you get from an offering of a testing kit is going to be fake unless it comes through those official channels. We've also seen a lot of fake sites set up for PPE and protective equipment. That has gone into a nationwide shortage. We've seen many people, particularly advertising through mediums like Facebook, Instagram, Twitter, various social medias, setting up adverts to fake sites and just taking your money and not delivering any sort of product. And unfortunately as well, we have also seen charities set up, or at least fake charities posing as real ones, and just soliciting donations to these fake charities. It's gone so far as the WHO, the World Health Organization, has released a list of recommended charities if you do wish to make a contribution financially towards the fight against coronavirus, as there are so many fake charities being set up now. Another avenue of attack we've seen is obviously there's been a huge increase in video conferencing now that we're working from home, and Zoom, a relatively small organisation in terms of the global video conferencing scene at the start of this pandemic, has seen a huge uprising. I think they went from something like 10 million to almost 300 million daily users, and so a massive increase on their end. The primary way to join a Zoom call is via a Zoom link, and obviously a link is what hackers and malicious users are wanting you to click on. So they have exploited this, and we've seen a huge increase in Zoom domains being created, and they're trying to get you to click on these links. So that is another one to watch out for. And I will, at the end of this presentation, hopefully give you some information on how to spot what is a real domain and what is a fake link. We've also seen a rise in text scams and text messages going around. This kind of follows the government's official warning text they sent out on the coronavirus. In the UK, we don't have, like you might have seen, screenshots and films and things like that. In the United States and other countries that are quite prone to natural disasters, they have a kind of advanced warning system that can be sent out to all members of the public through notifications. The UK doesn't have one of them, as we've not seen any need for one up until this current pandemic. So they just sent out a text, and they sent out a text to all mobile phones in the country, which resulted in hackers quickly taking advantage of the situation and sending out their own text to try and get people to fall for that. So we've seen texts about lockdown fines shortly after the lockdown was imposed in the country, just at the tail end of March. We've seen texts claiming that an individual has been cited leaving their home and they should expect a fine, perhaps even click a link to pay the fine. These were fake, and the government had to go as far as to issue a statement to say that they've only ever sent out one text and had no intention of sending another. So caution is advised on any texts you see impersonating the government. And then very recently, what we have seen is with the news of the NHS app being trialled in the Isle of Wight, the contact tracing app, we have seen contact tracing text scams, where you'll receive a text advising you to start to socially isolate as you have come in contact with someone who's infected, and if you need more information, to click the following link. Again, this is fake. There is no intention by the UK or Scottish government to send out text to people to warn them of interaction with a potentially infected individual. So caution, again, advised when you receive any texts like these. We have also unfortunately seen a rise in malware being spread through the coronavirus pandemic. This is being spread primarily through Word or Excel documents. You'll be sent one through an email and be asked to download it and fill in some information. So if you do receive an attachment on an email, please make sure that before you open it, you're absolutely certain you know that the person you're receiving the email from is in fact the person you are receiving it from. You know that is that legitimate person, and if there is any question of doubt, it can never hurt to either pick up the phone or drop them a text on a different medium just to make sure that email is legitimate. We've also seen the rise in some fake Android apps on various Android websites and stores, basically claiming to be information apps or to keep you up to date when these are in fact fake. The way these are being installed on people's phones is people are using the non-recommended Android App Store. Google, the makers of Android, recommend their Play Store, the Google Play Store, as the only way to download Android apps, as they have those apps have been verified to be authentic. If you go to a website, or if you go to a website and you're not sure that it is completely authentic and asks you to download an app, you should never download it on your phone, as this could be malware. And when it comes to particularly apps mentioning the coronavirus, it is probably best to stay away until there is an authentic solution, such as the NHS app. But that will be released in due course, and there will be plenty of information on the official ways to download that app onto your phone. So I've spoken a bit about the various scams and risks that we're seeing with coronavirus. So if you have had a presentation from us at the SPRC or from Graham before, you'll have seen us talk about this before. But these are our best, or the advice that we would offer to best prepare yourself. So firstly, now that we're all working from home, a lot of us are probably using personal devices to do the work, unless you're fortunate enough to be provided with a work device or managed to get it out of the office before lockdown came into play. Updates are as important as ever. Make sure your device is up to date, and now that you are on your personal device, it is your responsibility to keep them up to date. So always ensure that your device is up to date. Give yourself some time in the day to check for updates and install it. Perhaps leave it on before you go to bed and leave it on through the night just to update. And these offer great rewards and generally don't require that much effort other than giving it the time to update. Passwords and passphrases are very important as well. Just make sure you're having a strong password or passphrase. We're now saying passphrases because we're finding that one word is no longer cutting it in terms of being secure. So we'll recommend a passphrase, maybe 3 or 4 words put together. You can take lyrics out of a song, pick a few objects in your room or in your garden, whatever you can see, just put them together, throw in some numbers and maybe an exclamation mark or a question mark, something like that, just to enhance the security of the password or passphrase. Also now, if you are working collaboratively as a team and you're having to share passwords and passphrases, make sure that those are being shared through secure channels. I would advise against sharing them through an email, and perhaps use some sort of encrypted messaging service like WhatsApp or iMessage if you have an iPhone. As well, backups are essential in ensuring that your information is kept safe in the event of either a device failure or a ransomware attack. We like to recommend the 3-2-1 method when it comes to backing up. So that's 3 copies of the data on 2 different mediums in one different location. So for example, say you've got an important Word document that you want to back up, 3 copies of it, save 1 copy on a USB drive and 1 in the cloud, and that would reach your 3-2-1. You've got the original copy on a USB and 1 in the cloud, so that's offsite as well. So now I mentioned phishing earlier, so I want to talk a bit about phishing prevention and how you can be best prepared for phishing emails when they come through. And the best way to do this is to learn how to read URLs. So to do that, I'll walk you through the way I think is best to understand URLs, and that is comparing them to physical addresses. So in my first year at university, I stayed in student accommodation, and that is the address of the student accommodation in my flat. So we'll use this as an example as to how to read URLs. So here is the URL for accessing information on your Google account. So first thing to know about URLs is that we read them backwards rather than left to right. So we'll do that when we're reading this URL. So I'll bring in the address to help us do that. So firstly, anything after the / you can ignore. That's just information within the web page that the computer will use to navigate to the right page. So firstly, we could compare the general location, which in the case of my flat was Dundee, to the whatever is at the end of the URL. So in this case, .com. Then we find out the website that we are going to or the street, which in this instance is Google. And then we find out the specific area you're going to on the street or the house or the flat. In this case, on the website, it was the My Account page. And as a side note, it's always important when you're looking at URLs to make sure that you see that S after the HTTP. That means that your traffic is encrypted so that no one can potentially see any passwords or email addresses that you're sending to the website. So to use an example to understand how this works, we'll look at this this man here. This is John Podesta, and he was Hillary Clinton's campaign manager. Now, if you have followed Hillary Clinton's campaign for president, you do know that she was involved with a very large email scandal, and that was because this man fell for a pretty severe phishing campaign. So this was the email that he received. On first glance, it looks pretty authentic. That looks like a Google account. Everything there looks pretty real, and you can't really blame him for falling for it. So what we'll do is we'll take a closer look at the URL that he received. So this is the URL spread across the page, the domain. So if we bring in the address again and follow the way that we read it earlier, we can see that the city that we're in, or the actual end of the URL, is .tk. So straight away, we can identify that there's something not quite right there. Then we look at the street, or in this case, the actual page that we're on, and you can see that it's com-security settings page. So again, looking a bit dodgy there. And then the specific page on that URL is Google. So this isn't actually the real Google website we can see. The actual website we're on is com-security settings page. That's the street in this example. And then on this example, there's my account has been thrown on the front of it. So we can see that through this method, we can identify that this was a malicious domain. So hopefully, just by taking that advice on board, reading the URL back to front, you can help identify any URLs or domain names that don't look quite right. And if you do receive one of these emails or see one of these domain names, what should you do? Well, if you are ever a victim of a cyber incident, the first thing I would advise you do is absolutely contact Police Scotland through their 101 number or your local police station, and just let them know that you've been victim of a cyber incident, and they can point you in the best direction as to where to go from there. But even if you just receive a phishing email and don't happen to be victim to a cyber incident, the NCSC, the National Cyber Security Centre, has set up this new this new email inbox for their phishing takedown tool. So if you receive a phishing email, forward it on to this address on screen, and then they will identify if it is legitimate or not and do the best they can to resolve the issue and hopefully take down the website. This tool was launched just over a month ago, I believe. We've already seen, I think, over 300 websites being taken down already. Sorry. So absolutely invaluable to the government. If you're reporting these phishing emails, they often go underreported. So the more reports we can do, the more fighting chance we have against these scammers. But I think that brings us quite nicely to the hour mark. So that's it from me, and I'll pass you back to Graham.
Yeah, thank you very much, Declan. I did wonder how long it would take somebody, when I saw the Isle of Wight testing the contact trace app, I wondered how quickly somebody would start to send out scam emails, and clearly it has happened. But yeah, I would urge everybody listening to use that address as much as you can, the report address that we put up in the last slide, to send in any emails that you think are malicious, because as you do that, you actually contribute to the UK cyber security, because you begin to give the National Cyber Security Centre the tools to actually build the defences to resist them coming in the first place. So yeah, that would be absolutely great if you could, folks. And thank you very much indeed, Declan. We've got a couple of questions still to answer. Some of them are actually very nice comments about the speakers, so thank you very much indeed for them. We've got one, Declan, which I'm reading it correctly. It's somebody saying, what are the ways that we can inform our customers how to stay safe online? What kind of resources are out there that they can use?
So in terms of resources, two best places to go, I would say. Firstly, the NCSC have tons of advice ranging from information and advice for the individual all the way up to board levels for businesses and organisations. And we as well at the SPRC have numerous fact sheets on various social media platforms and best practices for passwords. And we've recently published advice on video conferencing and what tools to choose to video conference securely.
Excellent, thank you very much indeed, Declan. Also, one for you, Stephen, from Charlie Meehan. The PRA rulebook 8.9, so we would be unable to use our spare capital as a buffer if this would take us below the 10%, although presumably we can apply to the PRA to be allowed to do so.
Yes, I mean, you could certainly have more in your reserve than the minimum capital requirement. If you're less than 10% capital requirements, then you can't make a transfer from your general reserve, and it is just the general reserve, sorry, the general reserve that they mentioned. So that would mean if you're looking at transfers to other reserves or distributions such as dividend, interest, you could always ask the PRA, but I'm not sure what their views would be.
Okay, thank you, Stephen. Thanks very much indeed for that. And I think a final question from Cam Wallace, Declan. How do we close an old Hotmail account for one of our volunteers that they used or that has been hacked and used to send out emails?
So if that is a Hotmail account that is managed by an IT provider, I would get in contact with them. If not, you might be able to get in contact with Microsoft themselves. I'm sure they have a helpline on their website, and you can let them know that the account has been compromised. And they should be able to either take that down for you or give you back access if that's what you wish to do.
Yeah, I think the thing is that Hotmail accounts are no longer looked after by Microsoft. They've stopped supporting them effectively, but I think there are still ways to get in touch through Microsoft at help or whatever. So certainly, yeah, I would try and look for that. Okay, and I think that's really us, folks. I think that's all the questions, unless any of the panelists have got anything else they wish to say. No. Okay, well, listen, it only remains me, first of all, to thank our speakers, and thank you for giving up your time and your expertise, gentlemen. Really hugely appreciated, because without you, it certainly wouldn't be possible. And to thank everyone participating in the webinar today. Your attendance has been hugely appreciated as well. A wee reminder that if you want to sign up for, or you want any of the materials that Declan was talking about, it's at the Scottish Business Resilience Centre website, sprcentre.co.uk, and you can sign up for our regular mailing list there as well. Also, just to let you know that the recording of the entire webinar and the slides will be sent to you, or the link for the website will be sent to you possibly tomorrow or the day after, and that will be the full recording of the webinar with the slides as well, so that will come out to you. And if you have any questions at all, or if we at the centre can do anything for you, you have my email address in the original invite. Please feel free to get in touch. But it only, as I say, remains on me to say thank you very much to our speakers. Thank you very much to everybody who attended, and to urge you all to stay safe at this really challenging time, and hopefully see you all very soon. Thank you very much indeed. Thanks.
Thanks, everyone.